The cryptocurrency market is surrounded by but also built on ever-changing predictions about its future. Some believe in a future ridden with Bitcoin and blockchains, while others predict a steep downfall. Either way, it's becoming increasingly and worryingly hard to imagine a future without Bitcoin and cryptocurrency at large. In today's video, we will be discussing how Bitcoin will disrupt traditional finance forever. With cryptocurrencies on the rise, traditional banking is currently facing a blow that is only expected to surge further. In fact, it doesn't seem too far-fetched to assume that the world is not far from living entirely on Bitcoin and blockchain. A dramatic surge in small retail banks called challenger banks. The financial service industry is already witnessing a dramatic surge in the number of challenger banks worldwide. Based primarily on personalized banking services and weaponized with innovative technological devices, challenger banks promise to reinvent customer care. Major challenger banks in the UK such as Starling Bank, Monzo, Revolut, and Metro Bank compete with bigger traditional banks by their use of modern financial practices. Because challenger banks are mostly based on online transactions and app-based banking, they save operational costs by requiring little to no in-person customer interface. Strict verification checks ensure security and build customer trust. Challenger banks also tend to offer tools such as budgeting, spending notifications, and investment advice. Apart from their visibly practical perks, challenger banks also come in pretty wrapping. Credit and debit cards as well as the feasibility of online shopping and retail establishes them as very charming prospects that are secure but also convenient. In this way, traditional banks are undermined and relentlessly replaced by an option that seems much more reliable to the masses. Challenger banks also tend to be a much more convenient option for online transactions, especially in times such as these. Safe to say, the global health situation has fueled the rise in the number of challenger banks, and the industry is expected to grow at a CAGR of 48.1% from 2020 to 2027. The decline in traditional banking. Huntington Bancshares, Wells Fargo, and Sierra Bancorp all announced branch closures in the past few days in Ohio, Philadelphia, and California, respectively. 368 bank branches in 2020 and 4,000 banks in the past 6 years have been closed down in the UK as customers turn to online banking options. 6 months into 2021, TSB has announced the closure of 155 branches altogether. Low interest rates have also forced commercial banks to cut down on operational costs. The US also seems to be undergoing a very similar decline in the number of commercial banks and foresees extinction by 2035. The declining competition between banking bodies threatens financial instability. There has been a noticeable reduction in the importance of deposits for financial intermediation. At the same time, traditional banking activities such as loans for businesses have also become increasingly unpopular in recent years. In the United States, the role of commercial banks as sources of funds has decreased dramatically from 35% in 1935 to 22% today. In these times of desperation, banks are beginning to turn to non-traditional ways of banking that make them more susceptible to failures. This decline in banking due to an influx of digital banking as well as digital currency threatening to make the financial system more fragile. Crypto trading versus stock trading. Crypto trade is the exchange of digital currencies such as Bitcoin and Ethereum, while stock trade is the regulated exchange of company shares and stocks. Buying shares in a company via stock exchange would be synonymous to owning a specific percentage of said company. The value of your share depends on how well the company is doing. On the other hand, crypto trade is independent of any establishment, and its ownership does not grant shares in the seller company. With digital assets becoming increasingly valuable to investors, stock markets seem to be in neck-to-neck duel with crypto markets. Much like stock trading, cryptocurrency offers profit as well as ownership. There's not much that sets off stock trade from crypto trade except for the feasibility that cryptocurrencies offer. Devoid of any involvement from a third party, cryptocurrency is heavily favored. However, stock markets have existed far longer than crypto markets and are much more developed and reliable. Crypto markets have a greater potential of being manipulated and subsequently to crash. The market cap in stock exchange is much higher than in cryptocurrency, and so it is much easier to hoard. Because stock exchange is a relatively older market, it tends to be much more heavily guarded in comparison. There are rules as well as fees to safeguard traders and investors alike. This makes stock trade a safer bet to crash on and a safer bet to count on. Bitcoin enables convenient transfers across borders. Unlike banking, cryptocurrency comes with the feasibility of costless transfers across borders. Cross-country remittances can add up to several $100s upon transfer as well as receival. Although the market still tends to be alive, it isn't as lively as it once was. Heavy taxing on transferables is another unattractive aspect of remittance. A remittance transfer of US $500 to another part of the world can cost up to $49.95, which is a whopping 10% of the original amount. Although measures are underway, the remittance industry has a lot farther to go before finding itself in a positive compatible with widely known cryptocurrencies. On the other hand, there's no delay between transactions nor any fear of foreign currency inflation or deflation when it comes to Bitcoin and other popular popular cryptocurrency. Bitcoin is not regulated by any centralized institution and is instead organized and verified by a mathematical authority referred to as the cryptographic encryption system. Investors are cut free of any hassle of third-party involvement. This means that transfers are untraceable, and so tax can only be imposed once Bitcoin has been liquefied. This makes Bitcoin an option that is much more sought for, especially in comparison to banking. Bitcoin is not regulated, at least not by the government. Cash received by businesses requires filing of currency transaction reports on each payment. This doesn't apply to cryptocurrency. Businesses are not required to file written documents of transfer upon payment with crypto. This makes tax avoidance a lot easier, and the process conveniently opaque. Thus, Bitcoin makes tax fraud worryingly convenient. Cryptocurrencies shield income from the IRS, which means that the federal government is hopelessly blind to certain transactions. Crypto wealth also happens to be concentrated amongst a peak percentile, with only 2% of accounts controlling 95% of all Bitcoin. This further accentuates the tax gap, which exists between tax-evading millionaires and working-class taxpayers. The White House Treasury estimates a $7 trillion gap over the next decade. Taxable assets can be conveniently shifted into the crypto economy to avoid taxes. Safe to say, Bitcoin makes fraud so convenient that it seems weirdly tantalizing. The increasing reliability of cryptocurrency and the ever-frustrating inflation of money. The relentless printing of paper money without any increase in its real value causes monetary inflation. The US dollar has lost over 96% of its value since 1913. 46% of the dollars in circulation were printed in the last 12 months alone. This makes the dollar and currency at large a very unreliable market of investment. Bitcoin, on the other hand, much like other cryptocurrencies, resists inflation. Bitcoin has increased in value much quicker than the US dollar has lost its value over time. Being a market based primarily on volatility, Bitcoin has fought one too many spikes and declines, but the general trend line has always been upwards. Going from $0.08 in 2010 to $45,000, peaking at $50,000 in 2021, the monetary value of Bitcoin is predictably but also evidently on the rise. The global health situation and the crypto market. The Bitcoin has surged in value from $7,300 at the start of the global health situation to $46,800 today. Other leading cryptocurrencies have experienced similar success by winning over considerable attention from keen investors. With some countries restricting trade as part of lockdown protocol, investors look for options such as cryptocurrency to invest elsewhere and to invest internationally. Because the crypto market is decentralized, it naturally becomes a much more attractive option for investors in comparison to traditional financing. Costless transfer with little hassle of foreign currency inflation, investors tend to look up cryptocurrency as a reliable option in these trying times. Biden's compliance agenda. On 20th May 2021, the U.S. Treasury Department released a report, The American Families Plan Tax Compliance Agenda, detailing President Biden's initiatives to establish a more equitable tax regime in the United States. The plan aims to invest a whopping $80 billion in the revitalization of the IRS to offset $600 billion of tax gap. The Treasury report proposes tax compliance on less visible income sources such as Bitcoin and other cryptocurrency that disproportionately benefits higher earners and enables them to evade taxes. Biden's compliance agenda would give the IRS access to information relating to financial assets and transactions and cryptocurrency. Details of proposed provisions are still unclear, but an increase in regulations is to be expected. Cryptocurrency and crypto assets take center stage in Biden's compliance agenda. Biden predicts an increase in the value and popularity of cryptocurrency and so proposes efficient methods and measures to regulate its circulation. The plan acknowledges the leeway that cryptocurrency provides no tax evaders and aims to strengthen the IRS to keep a watchful eye on all crypto exchanges. If the Congress approves of Biden's compliance agenda, crypto trade and transfer would inevitably become less opaque and the crypto market would become less volatile and more heavily guarded.